Sudden global shifts are currently overriding the standard economic signals we usually rely on. This is especially clear in the price of mortgage-backed securities, or MBS, which are the bonds that dictate mortgage rates. Take the latest weekly jobless claims data. The numbers hit 210,000, exactly as economists predicted. In a typical market, this consistency would provide stability, but right now it is having no measurable impact. Instead, threats to global shipping lanes have become the primary driver for domestic mortgage costs. Tension is high regarding ships transiting the Strait of Hormuz. Markets are bracing for a Saturday deadline regarding the reopening of these channels and the possibility of military intervention to keep them clear. Oil prices are reacting to this vulnerability. WTI crude oil is trading above $94 a barrel, up nearly $4 in a single session. WTI, or West Texas Intermediate, is a specific blend of oil used as a global pricing benchmark. In this environment, your mortgage rate is increasingly influenced by these external conflicts rather than domestic data alone. We can see the cost of this instability in the charts. Mortgage rates have jumped at least 34 basis points in just the last 3 weeks. A basis point is a unit of measure equal to 1/100th of 1 percentage point. This spike in borrowing costs corresponds directly to rising energy prices. Higher fuel costs drive up the expense of transporting goods, which in turn fuels inflation across the entire economy. This creates a difficult choice: lock in a rate today at these higher levels, or float your rate in hopes of a future decline. Attempting to time your closing based on daily war reports and social media updates is an exhausting process that carries significant financial risk. Making a long-term commitment like a mortgage based on short-term geopolitical headlines is a high-stakes gamble for any household budget. If you are closing within the next 30 days, you are operating in a window of extreme volatility that favors a defensive strategy. Last month, import prices rose 1.3%, the largest increase in nearly 4 years. This was driven heavily by the cost of energy production and industrial refining. This is known as sticky inflation. When energy costs rise, companies pass those expenses to consumers, keeping inflation higher for longer than economists would like to see. This resurgent inflation puts immediate upward pressure on Treasury yields, which are the interest rates the government pays on its debt. The market metrics prove this pressure is real. The 10-year Treasury yield is currently at 4.37%, and the 2-year yield has climbed to 3.92%. Because of the weekend deadlines regarding shipping channels, investors are pricing in more risk every Friday afternoon, which typically pushes rates higher heading into the weekend. Choosing to float within a 30-day window leaves your loan exposed to these sudden and uncontrollable headline-driven spikes. However, if your closing date is 60 days away or longer, you are looking at different economic indicators that suggest a cooling period. Several major investment banks are lowering their growth forecasts for the year. Morgan Stanley, for example, cut its projection for consumer spending growth down to 1.7%. The housing market is also showing signs of a slowdown. The Mortgage Bankers Association Applications Index, which tracks the number of new loan applications, recently fell by 10.5%. Purchase transactions, actual home sales, just saw their largest weekly drop since January, falling more than 5%. Goldman Sachs now estimates the risk of a recession in the next 12 months at 30%. They also project that unemployment will rise to 4.6% by the end of the year. These cooling signals are the primary reason mortgage rates could eventually move lower, as a slowing economy typically leads to lower bond yields. While the day-to-day news on the trading floor is loud and chaotic, the underlying long-term data points toward a broader economic slowdown. Floating into a 60-day window is a strategic bet that these recessionary forces will eventually outweigh the short-term energy spikes. This creates a direct conflict between two powerful financial forces. On one side, geopolitical energy inflation is pulling rates higher as the cost of extraction and shipping rises. On the other side, weakening consumer demand and rising recession risks are pulling rates lower. The market is currently deadlocked. We saw this in the recent Treasury auctions for 2-year and 5-year notes, where demand from institutional investors was notably weak. Because these forces are in opposition, there is no single right answer for every borrower. Your strategy depends entirely on your specific timeline. This lock versus float matrix provides a clear framework for making a decision based on your closing date. For those closing within the next couple of weeks, the recommendation is to lock. You are too close to the deadline to risk a sudden market shift. The technical indicator to watch is the PAR 100 level. PAR 100 represents the price at which a bond trades at its face value. If mortgage bonds fall below this support level, your rate will likely increase immediately. If you have more than 60 days before you close, you have the flexibility to float your rate while watching for the long-term economic slowdown to lower yields. This strategy requires daily monitoring. You must watch the 10-year yield closely and be prepared to lock if oil prices take a sharp turn upward. Defining your exact timeline is the most effective way to protect your budget from market volatility. Locking your rate provides protection against weekend news cycles, while floating is a bet that a recession will eventually drive yields lower. Broad market data cannot predict how these shifts will impact your specific monthly payment goals. Rather than reacting to global headlines, you should focus on the specific numbers of your transaction. You can use the contact information on your screen to receive a detailed analysis of the costs and benefits for your specific loan. Executing a strategy based on your personal timeline provides more protection than attempting to predict the next global headline.